I'm an advocate of value investing, which I think will be the best approach to owning stocks in the foreseeable future. I recently read a good analogy by Jim Bianco, which I want to highlight and paraphrase. He said, riding the S&P 500 index has been like sailing with a 20-knot wind at your back. And all you have to do is put out the sail, look for the horizon, and go. Sailing skills don't come into it very much because you have this strong wind pushing you along from behind. And that's what years of money creation instigated by the Fed and other central banks did for stocks, specifically for the S&P 500. Nearly all U.S. stocks moved together, mostly higher, and the wind was at your back. But now there's a new sheriff in town, Donald Trump, and his deputy, Scott Bessent, who think Wall Street has been unduly rewarded, and now they think it's Main Street's turn. They've said so. The Fed can no longer wantonly, flood the world with money because the Fed has discovered inflation risk. So now the monetary tailwind has died down, and at these lower wind speeds, you need actual sailing skills to reach your destination. You have to tack and jibe and read your compass and anticipate the weather. That's the sum total of my sailing terminology, by the way. But in the same way, we now need stock picking skills or somebody who has those skills. And I believe that the sooner investors understand this, the better they're going to feel about their investment strategies. Now, as readers of my book know, when it comes to the stock market, as I said, I'm a value investing advocate with an emphasis on investing in stocks of companies with a growing dividend stream. To a dividend-oriented investor, lower stock prices are really your best friend because your dividend yield is higher. So evidently, eventually, we're going to be coming into a target-rich environment that's very good for cheap dividend-related stocks, but we're probably not quite there yet. All right. For the rest of our time today, I want to focus on gold because one of the major long-term consequences of excessive, unproductive money creation is an increase in the price of gold. The gold price does not move in lockstep with the increase in the quantity of money. But over a long period of time, the quantity of money is a big determinant of the gold price, especially following periods in which large amounts of money have been created unproductively and irresponsibly. So the gold price doesn't respond directly or immediately to the quantity of money, but eventually it does respond to the economic consequence of that money creation. For example, as I spelled out in Chapter 6 of Black Hole, the irresponsible money creation under the Fed's QE program pushed interest rates on treasury bonds to near zero, which made government borrowing appear to be free, which encouraged Congress to balloon the government debt and deficits. But now the higher interest rates have returned, and the U.S. can no longer afford to repay that debt without a massive dilution of the dollar's value, which makes holding gold look pretty good as an alternative to holding the dollar. So the reason I want to highlight gold today is this. Even while the bloom on the stock market is fading, investing in gold is finally starting to come to the attention of mainstream investors in the Western world, especially in the USA. This awareness is just setting in, which tells me that even though the gold price has risen a lot recently, it is still very likely got a lot of upside over the next several years.